Tax Loss Harvesting Explained on this edition of WealthWise. Tax loss harvesting. It's a term that many of us hear, but few of us understand. I'm Deanne Rosso, President and CEO of Elevate Wealth Advisory, and today we're speaking with our wealth advisor, Rob Fezekas, who's going to help us understand what tax loss harvesting is all about and how to integrate this strategy into your year-end planning. Thanks for joining us, Rob.
Well, thanks, Deanne. Now I'd like to talk about another year-end planning item with a 12/31 deadline, and that is tax loss harvesting. Tax loss harvesting is taking advantage of a provision in the tax code that allows one to offset capital losses against capital gains. And this is a strategy that's probably easier to implement in a year like 2022, in which we've experienced some market losses. Also, this is a strategy that does not apply to retirement accounts like 401ks and IRAs and Roth accounts. It does apply to taxable accounts like brokerage accounts. In those kinds of taxable accounts, when you sell an investment for more than you paid for it, typically you owe tax on the amount of the gain, but you might be able to offset some or all of that gain by selling other investments with unrealized losses. At the end of the year, you can net all the gains and all the losses together. And if it's at a gain, you'll owe tax on the gain. But if you're at a loss, you can even offset some ordinary income up to $3,000 if your net losses exceed your net gains. If it's more than $3,000, you can even carry forward those losses to offset capital gains in future years indefinitely. Before trying this strategy, be sure you're aware of the wash sale rule, which prevents you from being able to recognize losses in this way if you buy the same security or equivalent security within 30 days before or after the sale of the security with the unrealized loss. Well, thanks again, and thanks for watching WealthWise.